So thank you for those that's able to join today. I know we have some back-to-back workshop, but I'm glad this is going to be recorded. So I'm very excited to have Yonah Weiss here talking to us today. And not only he's a cost segregation expert, but he's also a very well-known investor as well. Before I get to his part of the presentation, just want to do a quick intro and a quick disclaimer as well to make the lawyer happy. So the information is for general purpose only and does not constitute any tax legal advice. So please consult with your own advisors before making those investment decisions. And we're not having any offerings here today. So I always start with this slide just because it's just so important to be reminded that, we're here to not just talk about financial freedom, time freedom, geography freedom, and, all that is possible with cash flowing assets, right? We can only have one or two jobs, so we can have as many cash flowing assets, apartment rentals, mobile home parks, and all that make the money work for you. And a little about me is I came to the US at 16 years old. You saw a picture of me and my husband and also my host family and my siblings in China. My brother is a teenager now, and sometimes it gets a little difficult working with him, but I love all my family members. My background is more in the data analytics, audit background, and supply chain and sales. It's a little bit of everything. And I became a landlord in 2019, really by accident through house hacking in my primary residence. Right now, I have a little bit over 1,000 units as a general partner and fund manager, and some units as limited partners as well. I started also investment club with a little bit over 700 members. And I started Life Mission Capital when I saw a need of busy professionals like me, especially first generation, second generation immigrants like me that come into the US without knowing the possibility of making your money work for you. So that's really where my passion is, helping people understand using those financial instruments to gain the freedom. And this is my team, my advisor and my underwriting consultant. And also other team members that's not mentioned here, but that's what makes it possible, because it's hard to be an expert just by myself. But with everyone's support and their expertise and their certifications, David is a CCIM certified investment member in the commercial real estate, and also Derek, he's a asset manager, acquisition manager for a $36 billion private equity firm. So really, we're here to help people, busy professionals especially, to really invest in real estate, build their legacy without tenants and toilets. Those are the things I crossed out. And also without worrying about not having the expertise with enough money to buy large apartment complexes. And without that, we do it through kind of the three-step process with sponsor selections. We work with experienced sponsors that typically has 1,000 units or so in that specific area that they work in, maybe Texas, maybe Arizona, and they have a successful exit of usually at least 3 to 5 opportunities already, and all their returns would have been either meeting or exceeding returns. And also we do the location level due diligence, and then we move on to the asset level due diligence, leveraging my data analytics audit background along with my partner's experience in those spaces as well. Eventually, we're trying to get to the trinity of freedom for people, and that's financial, time, and geography freedom. And I can't emphasize enough how important geography freedom is, not just about being able to travel, but being able to, my family is far away, but for a lot of you, maybe even if your family is a little bit closer, being able to travel there, right, spending the time to see them without worrying about finances, time, and all those are just so crucial. So without further ado, I'd like to welcome Yonah, as a few people triggered in here. So Yonah is a powerhouse with a property owner's tax savings. He's a business director at Madison Specs, a national cost segregation leader. He has assisted clients in saving tens of millions of dollars in taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He is not only an investor, but also a host of the top podcast called Wise Advice. I have listened personally a few episodes, and I found it very interesting as well. Yonah is also a LinkedIn guru, you could call him that. He has hosted multiple LinkedIn challenges. I've participated in some of them. He also hosts meetups, so many great things. And I know he's also venturing into being an active investor as well in syndications. So there's a lot of cool things that's happening with Yonah. And I know quite a few investors that uses your service as well. So it couldn't be more honor that you joined us today, Yonah. Really appreciate it. I'll leave the floor to you and make you a co-host now. I know you got some cool slides prepared for us, but it's a smaller group today. So if anyone has any questions, feel free to unmute and ask, or type in a question in the chat if you don't feel like asking.
Absolutely. And thank you so much for having me. Thanks for that great introduction. I'm surprised you've only listened to a few episodes, though. I would imagine you're you gotta up on it. Not everyone has times for every podcast episode, but I would behoove you all to go check out Weiss Advice. It is a great show. We interview some amazing people, and I'd love to get you on as well, Misi. So we'll have to arrange that after this call. Sure. And I'd love to actually, before I pull up the slides, just to get a gauge of who our listeners are. I mean, it sounds like you're all part of Misi's network here, so you probably have some investing experience. Maybe give me, if you would, open up the chat, and I would love to see what your answer is to the following question. Okay, so I want to know what your experience with cost segregation is. So I'm going to have you answer and listen up to the question first, either with the number 1, 2, 3, or 4. 1 is, this is the first time you've ever heard of the topic. Okay, so put the number 1 if this is the first time you've ever heard of cost segregation. Number 2, if you've heard of it, but don't really know what it is. You kind of come across it, but don't really get it. And then number 3 is going to be if you know very well what it is, and maybe you've even invested in some properties or used cost segregation service itself. Okay, so that's going to be number 3. I'm seeing the chat blow up right now with all those 1, 2, 3s. Okay, we got one answer. There we go. All right, there we go. But guys, put it in, please. Don't be shy.
What's 4? You just 1, 2, 3. What's 4?
Number 4 is that if you're actually the cost seg expert, and I'm going to make you the co-host, and I'll turn the presentation over to you. All right, so we got lots of 2s. Okay, so this is the first time. Okay, so it looks like Lee is 3.9. Getting close, not quite. Maybe after this presentation, you'll be the number 4. But so let's just jump in here. I think it's important that, we're all on different levels. So I'm going to make sure to explain everything clearly. You may not get everything the first time, but, and even if you listen to Weiss Advice podcast, you're not probably going to get it because we almost never talk about cost segregation there. Yeah. It's all about highlighting other investors.
Yeah.
But also, we keep that chat open, guys. And if you do have any questions, please feel free to ask it in there. And I'll share my screen now.
Yeah, and I know that a few of the people here, they are, maybe some of them they're just starting to invest. Some of them they are more active investors. Quite a few of them are more active investors as well. And I love that, and they'll probably have questions on this. I love that you'll touch on kind of the tax benefits, even though I don't believe you have a CPA, but a lot of the stuff is kind of standard general tax information as well.
Right, for sure. And you're absolutely right. I'm not a CPA. And as your disclaimer, I'm not here to offer you any tax advice specifically. I happen to know more about this topic than probably 99% of CPAs out there. And when it comes to things related to real estate as well. But again, I'm not a CPA, not doing any tax filing work whatsoever either. So we just focus solely on the cost segregation. But if you are a passive, why don't you write in the chat now if you're passive or active? Just write passive or active in the chat if you would, just so I get an understanding who's on the call. You can write, P or A if it's easier. Just P for passive, A for active, or if you want to do P and A. So Misi's a little bit of both. We got Chris who's active and Alex is active. Brooke is passive. Awesome. So short-term rental is active. Yeah, it can be. Short-term rentals can be passive also. It depends if you have a property manager taking care of it. Even if you don't, a lot of it can be automated. So that's awesome. And short-term rentals will definitely a way to go.
And it's important to recognize that because that benefit can be different depending on whether you're passive or active, right?
That's exactly right. Exactly right. And short-term rentals actually, maybe we'll get into it a little bit later, but have a really interesting loophole that no other property does have. And so maybe we'll talk about that in terms of the benefits for cost segregation. So I appreciate all of you kind of being active here in the chat. So I don't want any passive people in the chat over here today. You want to be active in this presentation. So we're going to talk a little bit about different things. So let's just jump right into the slides here. I'll try to go through it as quickly as possible, but make sure to cover everything. Depreciation, what is it? That's really what cost segregation is all about. So I'll explain what the basics of depreciation are and then how cost segregation applies to it. What are going to be the benefits, the downsides as well. We'll talk about bonus depreciation is a really hot topic. You want to understand what that is. And most importantly, what's a real estate professional? And this is kind of what Nisi was alluding to, this passive versus active. There are different roles in terms of how much you can benefit from the actual cost segregation itself. Okay, and then we'll do a case study and we'll step into some shoes of a multifamily and see what the actual real numbers are when we talk about cost segregation. So depreciation, it is, and for those of you who are, you said something this is the first time ever hearing about cost segregation, well, depreciation is a tax deduction, okay? Not to be confused with the actual definition of the word, which means something going down in value. It's actually a tax deduction based on that principle that things go down in value as time goes on. So the IRS basically says you bought a property, as long as it's a business or investment property, so this doesn't apply to your personal residence, but any property, you're able to now take a tax write-off based on the principle that it's actually going down in value, when in fact the property is actually going up in value, which is a kind of interesting. So I want to just make that clear. Depreciation and cost segregation in general is a borrowed term, okay, for this tax deduction. And so it's kind of an arbitrary years that the IRS has given for the amount of time you can depreciate a property. So for commercial property, it's 39 years. For residential, it's 27 and a half. So residential is actually going to include any multifamily. So not to be confused with like financing. For commercial properties, 4 units and up is considered commercial, but for multifamily, for tax purposes, it's still considered residential. People live there. If they sleep there, it's considered residential. The one exception is short-term rentals, which actually are considered commercial from that perspective because it's treated more like a hotel because of the transient nature of the rental. So what that means is when you buy a property, your clock starts at day one when you buy it. Okay, so it doesn't matter the property was built in 1956. If you bought it today in 2022, you get to start that clock of 27 and a half years, which means you can take that deduction over that time period. And if you sell it and a new person buys it a few years down the road, they get to start the new clock over based on the new purchase price. So it means that when you buy a property, you get to take that purchase price and deduct that full amount over that 27 and a half year period. But what cost segregation does is a tax strategy that's able to break out certain components in the property that actually depreciate on a 5, 7, or 15-year schedule, where it will take those components and take those deductions at a faster rate. Okay, so this is going to create more cash flow because you're creating more deductions during those earlier years of ownership. So just to kind of give you an idea of what that looks like. Let's say you buy a property for $1 million. You always have to allocate a certain amount for land, which does not depreciate. So land never depreciates. And so what you're left over is what's called your depreciable basis. This $850,000, that's what you can take as a tax deduction. But you're doing it over a long period of time. So what's called straight line depreciation, over a 39-year period, you get about $21,000 a year, or 27.5 for residential multifamily properties. Your depreciation deduction is going to be about $30,909. Okay, so talk about $30,000. What that means is if you make your net operating income, your income from that property, let's say on this $1 million property, is about $60,000. Okay, after all expenses and debt service, $60,000 is pretty good. I would say that's great because you're going to knock off, just with regular depreciation, you're going to knock off half of that, which means you're only going to be paying $60,000 instead of $60,000 going to be taxed on. You're only going to be taxed on $30,000. Okay, so depending on your tax rate, you're going to be paying a lot less just because of this depreciation deduction. But with cost segregation, I'm going to show you shortly, there's a technique that in the first 5 years, usually you're able to pay, get double or triple that amount over the first 5 years, meaning instead of a $30,000 deduction, you may be getting a $60,000, $70,000, $80,000, $90,000 deduction each year for those first 5 years, which means you're going to be paying zero taxes on your rentals, and even maybe have more deductions to offset other income, as we'll get into. So that's a pretty simple explanation of how depreciation works. And again, this is probably when we talk about like the tax benefits of investing in real estate, this is the number one tax benefit when it comes to investing in real estate. Because again, this is a very easy and clear way to literally pay zero tax on the income being produced from your rentals. And whether or not that's going to be able to carry over to other income, that's a topic we'll get to shortly. Okay, so how this works, okay, what are we actually doing with the cost segregation study? It has to do with an engineer, and not to get into the nitty gritty of it because we produced this 100-page report, which is very detailed in calculations, but essentially what we're doing is we're identifying every individual component in a property and reclassifying those to faster depreciation schedules. So when an accountant who doesn't know what cost segregation is or doesn't use cost segregation, what they'll do is just say, okay, Misa, you bought this property for $1 million. I'm going to put this, subtract a little bit for land and put it on a 27.5-year schedule. Your tax return, you're going to get a $30,000 deduction every single year, which means the whole building is being depreciated on this 27-year schedule. But that's actually not accurate. According to the IRS, there are certain components that are supposed to be depreciated on faster schedules, certain personal property components, and I'll give you an example in the next slide of what those things actually are, but certain things depreciate on a 5-year schedule. So our engineers go in and identify every single component and show you, oh, this depreciates on a 5-year, this on a 15-year, et cetera, and create this very detailed report showing you that and creating these depreciation deductions so you can get these deductions up front. So here's an example. We're talking about what are these actual assets. So we're talking about a multifamily property and really any commercial property, but these are specifically to multifamily property. We're going to divide a property into 4 categories, okay? We already talked about the land, which doesn't depreciate. The second one is going to be the building and the structural components. That's really all that's going to depreciate on that 27.5-year schedule, meaning the walls, windows, doors, foundation, roof. All that stuff is structural, and that's always going to be the majority of the value of the property. And when you buy a building, the majority of the value is always going to be in the structure, okay? But there are other things. The other 2 categories are what's called 5-year personal property, tangible property. This means these things like mount signage, right? Cable TV. These are just examples of what's in a multifamily property. Shelving or decorative lighting or moldings or appliances, right? Equipment, furniture, carpeting, millwork, even vinyl flooring. All these things depreciate on a 5-year schedule, which means when we come in and add up what all these components are, we can show you how the value of all these components are actually a very significant amount. And now we can take these tax deductions at a faster rate. The third category, the fourth and final category, is 15-year land improvements. So remember, land doesn't depreciate, but what's on top of the land actually does, meaning any asphalt or concrete or landscaping, anything, right? A swimming pool or playground equipment. You have a lot of these when you're talking about a multifamily property. And so the value of all these things can actually be really significant, especially if you're talking about a garden style multifamily property, the properties that Misa's buying, right? You got like 200 units and you have a clubhouse and you have a gazebo and you have a swimming pool and you have, a patio and concrete and walkways and sidewalks and driveways or parking lots, all that stuff. There's a lot of actual value in that. Well, if we can find out what the value is in that, we can pull those deductions out and take it at a faster rate. Now, 15 years may not seem like, such a great thing because it's faster than 27.5, but it's still kind of spreading it out over a long rate. We're going to talk about shortly this thing called bonus depreciation that's actually going to allow you to take all of these deductions up front in the first year. So this is what we're doing. Essentially, it's really the real name for this is called component depreciation. But the IRS, for some reason, wanted to give it this weird name called cost segregation just to confuse people and maybe turn people off from doing this. Like, okay, I don't want to have anything to do with this segregation stuff, so I'm not going to do that. But actually, it's just simply component depreciation. It's depreciating those components specifically as they are valued. And again, this is somewhat arbitrary and somewhat just a borrowed term because, again, when you buy a new property, your schedule starts over brand new. So it doesn't matter that, let's say, Misi bought a property like 2 years ago and you do it, but it's based on your purchase price. You buy this for $1 million, you do a cost segregation study and then sell it to a new owner. Their schedule starts over brand new. They can do a brand new cost segregation study, even though the same exact components are there, which is crazy. Because again, you would think, well, it depreciates over a 5-year schedule or whatever. It's already been depreciated. No, again, remember, this is just a borrowed term based on the new owner and their new depreciation schedule. So it looks like we have a question, and I think I answered that without even seeing the question in the chat.
Yeah, you did. Yep.
That's awesome. Yeah. So that's exactly the point. Is that it's not dependent, it's not intrinsic in the property itself. It's totally subjective and dependent on the owner of the property. And so it can be done, ad infinitum, really. I mean, obviously there's a limited time frame that we're living in, but theoretically it can be done every single time there's a new owner. So what types of properties are really going to get the maximum benefit? And this is a question I get asked a lot. Can you do this on anything? Yes. And as I mentioned, you cannot do this on your personal residence. But Misi talked about she was house hacking a property at one point, right? If you have, and house hacking means where you buy a property and maybe you're living in one unit, it's a small multifamily property, and you're living in one unit and renting out the other unit, or even in a single family and you're just renting out rooms. It can possibly be done in that as well, because any rental property, remember, you can take this depreciation deduction. Now, obviously, some properties are going to be more beneficial than others. Multifamily apartment buildings are somewhere around 25, 28% is going to be, and again, this is the amount of the total value that we're going to find in these faster depreciation schedules, like the 5 and 15-year. Short-term rentals, STRs, this is also a pretty good class. It's close to 30% on average that we're going to, again, take that purchase price, and then of that, we're going to accelerate the depreciation in certain costs. So again, this can be done on self-storage, hotels, you name it. Mobile home parks, MHPs, these are off the charts, okay? Literally off the charts. And we'll get to that in a second, why that is. And RV parks as well. I know it's both types of assets that you're investing in pretty heavily right now. And warehouses is really going to be the low end of the spectrum, because warehouses essentially, there's not a lot of personal property there. It's essentially just going to be building structure, not a lot there. So let's talk about mobile home parks for a second. Why is it so off the charts, literally between 50 and 80% on average of accelerated depreciation? And the simple reason for that is that you're thinking, well, I'm just buying land, right? Sometimes, but most cases, you're also buying the land improvements. And if you remember from the previous slide, land improvements depreciate on a 15-year schedule. So you have all the concrete pads under each home on mobile home parks, or you have, the streets or the concrete and all if there's a playground there, if there's landscaping, and you may not actually own any of the homes. They may be all tenant-owned homes, which means all you own is really the land and the land improvement. And some of the infrastructure like plumbing and septic systems and electrical infrastructure in the property you may own. And so therefore those hookups and everything is going to be considered 27.5 years. That's going to be structural property. But again, the majority of the property is going to go into those land improvements, which is pretty crazy. And which is why when we're talking about bonus depreciation and we're talking about cost segregation, mobile home parks are always off the charts and the best asset to invest in for that tax purpose.
That's interesting, because I think one of the opportunity I'm looking at, it only had 30%. So either they need to find a better expert, or they just maybe didn't have a lot of stuff to depreciate of.
There's a lot of factors that are going to go into it. It may have to do with it. There may just not be a lot of stuff there. A lot of these campgrounds and RV parks, it's just dirt. So there's not going to be a lot of concrete pads, as opposed to like a mobile home park where it's more developed and there's actually concrete there. But if it's literally just dirt, all you have is dirt, that's land. And you're not going to get the land improvements for the dirt, unfortunately. In other cases, there may be a lot of structures. I know we did an RV park recently where there was actually a lot of structures. There's a hotel on the property as well, and there was some single families as well. And so those had a lot of structural value in them, and it's all going to be looked at and lumped together as one whole property. And so the structural components are all obviously going to have, going to weigh towards where the depreciation is found. So yeah, every property is unique, and it's important to kind of find out what the benefits are going to be. That's one of the reasons we always run a free estimate ahead of time up front, so you can know up front like what are the potential tax savings here. So just to recap, I know a couple of people joined a little late here, but one of the key components of this is that we're not creating deductions out of thin air. What we're doing is just taking from that pool of potential deductions and front loading a certain portion of them. Okay, like maybe 20 or 30%, as I showed you in the previous slide. So what we're doing is reducing our tax liability by getting more deductions up front. And what that does increases cash flow. Now, that's most important nowadays more than ever, the time value of money, because with inflation, it's just crazy. If you have that money to reinvest now, that's worth so much more than letting just inflation take over. Forget about, the time value of money of having the money to reinvest. But if you just like, well, I'm going to pay the taxes anyways, I may as well just wait it out and pay taxes this year and not have to worry about that. No, the point is use the money, pay down your income tax liability and essentially not pay any taxes so you can use that money to reinvest. And so we'll get into bonus depreciation. But again, this time value of money concept has never been more important now than ever because of the rate of inflation. So who should be doing this? Can this be done by anyone? The answer is yes, pretty much, except unless you are a nonprofit or you're a government entity or you're investing from a retirement account that may already be a tax shelter. I know this is very important. If you have a 401k or you have an IRA and you want to self-direct that, oftentimes that type of retirement plan is already a tax shelter, which means you're not going to get the depreciation deductions from that. So it's really important to note, especially those syndicators out there who are bringing investors from these type of accounts, just have to be aware, maybe not everyone is going to get the same benefit. So maybe it's not going to be worth it. There is some ways to kind of adjust the operating agreement to maybe potentially give some deductions to some of the investors or different classes of investors, et cetera, if you set it up properly that way. But essentially, anyone can do it. Doesn't matter what type of entity is set up. It's a pass-through, a corporation or LLC, partnership, doesn't matter. The tax benefits are going to flow through to the owners of that and, and equally. Most times it's going to go according to the percentage of ownership. So if you have, 10 investors all together, each one is going to get 10% of the depreciation. Just flowed through to them. So it's pretty good. And this also flows through to passive investors. So this is really important because passive investors are going to get these depreciation deductions and essentially, at least on their passive income, meaning their rental income, any income from real estate investments is all going to be lumped together in terms of income. And so this depreciation is going to go to offset that. So there's really no other investment that I'm aware of, maybe oil and gas, but for real estate, in all investments in general, businesses or stocks or anything like that, there's no other type of investment where the returns that you're getting are essentially going to be tax-free during the life of ownership because of these cost segregation, these depreciation deductions. So if you are looking to invest passively into syndication or something like that, and you're looking for these tax benefits, find out if the syndicators are using cost segregation because that's probably something you're going to be interested in as a passive investor. I know I am. And so let's talk about this I just mentioned before a minute ago about this passive income and your depreciation is going to offset that. Well, there's really one big exception to this, and this is someone who's called a real estate professional. So typically speaking, all rental activity, all rental income, which means any investments in real estate, is going to flow through to what's called your K-1. That's a tax form that shows your losses and your income from your investments. Well, all of that's going to be treated as passive income. Depreciation is going to be used to offset that. However, if you're not a real estate professional, let's just talk about everyone out there. If you're just a busy professional, you have a W-2, you cannot use the real estate, this depreciation deductions to offset any of your active or W-2 income. The only way you can do that is if you are a real estate professional. And so what is a real estate professional? And this is a really important definition because if you do meet this, then this is really where the major benefits of cost segregation come into play because it's not only going to offset your rental or your passive income, but it's also going to be used to offset all forms of income you have. And essentially, this is how people in the real estate business pay zero income tax whatsoever. Because they're using it to offset all their income. So the way that you get this status, and this is directly from the IRS, this is a definition, this is a terminology, and you just fill this out when it says your occupation on your tax return, real estate professional, that's what it means. You automatically get this status. You qualify for this if you or your spouse, so only one of you needs to qualify for this in order to get this definition, and then it can be used to offset both incomes. So this is really important. Also, if maybe you can't get this, but if your spouse can, then you're in the money, essentially. You have this benefit. So you need both of the following requirements. Number one, you need to be in more than half of your time, which essentially means you can't have a W-2. You have to be full-time in the real estate trader business, materially participating. So this is really important, emphasizing these two words here, materially participating. I'll talk about that in a second. And then you have to be at least 750 hours a year. This means, okay, so you need both of these. You need, your full-time job is in real estate and you're spending at least 750 hours a year, which is not a lot, but it needs to be tracked. And you can't just, sit on the beach and retire and not do anything. You actually have to show that you are materially participating. And what does that mean, materially participating? So it means you're involved with any of the following activities: developing, redeveloping, constructing, acquiring, converting, renting, leasing, operating, managing, or brokering. So this is really important when it comes to brokering. Brokering means if you're a real estate broker, guess what? You automatically qualify as a real estate professional, which means if you are a real estate professional, you need to be taking advantage of this tax deduction, this tax benefit, which means you must. I mean, most real estate brokers that I talk to don't even know about this. But if you or someone is a real estate broker, you need to tell them this, because if they're not investing in real estate as well to get the depreciation and the cost segregation benefits, they're missing out, and they're just paying, huge amounts of income tax that they wouldn't have to had they invested and had the depreciation. Okay, so again, just to recap, if your full-time job is in real estate, you or your spouse, then the depreciation, this cost segregation, again, depreciation and cost segregation, I'm using them interchangeably because essentially it's the same thing. Just cost segregation is like an advanced form of depreciation, is getting a lot up front. But what that means is those deductions can then be used against your active or your W-2 or your spouse's W-2 income. So this is really, really important, and probably the biggest benefit that all people have when we're talking about cost segregation. I did mention before briefly that there is one other kind of loophole when it comes to short-term rentals, and maybe we'll get into that a little bit later. And if any of you have any questions on any of this, please put it in the chat or feel free to follow up with that. There is, again, one exception to this, is that if you make less than $100,000 of adjusted gross income, then you could take $25,000 from your passive deductions to offset your active income. But usually if you're investing in large properties, your adjusted gross income is usually more than $100,000. But again, this is one exception, and it phases out up to $150,000. So basically between $100,000 and $150,000, there are some losses that you can use against your active income, even if you're not an active real estate professional. And Nisi, what was your question there?
It was the question. It was a comment. I said it's best when it's awesome when you can deduct against your W-2 income. Otherwise, it's a lot of excess tax benefit we can't really take advantage of.
Well, that is true. Not necessarily in the current year. You're absolutely right, though. If you do a cost segregation, you're just a passive investor, and you get this big excess loss, as it's called, like a paper loss. Well, it may not benefit you this year, but that loss carries forward, which means you can use it next year on your investments or next year. Or if you have this excess loss and then the property sells, then that loss is released, which means it can be used to offset the passive gains from the sale of the property as well. So it's not all, the payday comes not only as the active investor from the income that you're getting and not paying taxes on, but also on the sale, you may be able to offset some of those gains from the sale of the property from those losses as well.
That's true. It's also a very good way to as alternative to 1031 exchange, because if you can get such a huge tax benefit already, why wait? You have to do it within, I don't remember how many days, I think 90 days or something,
right,
to do the exchange, which is very stressful to do that, versus you can take advantage of it just by finding opportunities with high tax benefit.
Yeah, that's an excellent point as well. A lot of people aren't aware that, if you don't do a 1031 exchange, people think you're just going to pay this huge capital gain tax bill. But essentially, there is a way, like you said, through cost segregation of getting these losses and using that to offset the gain as well. So let's talk about the Tax Cuts and Jobs Act. This is probably the biggest tax reform in our country's history, at least in the last 50 years for sure. And this brought to being the biggest benefit that ever happened to real estate investing, which is called bonus depreciation. Okay, so it actually used to be such a thing called bonus depreciation for new constructions, and it was specifically only 50% of the money spent on new construction you could take as a write-off right away. for certain components. But what this came to be was that any property since 2017, or basically 2018 when the property came to pass, that you're allowed to take 100% of the assets that are accelerated. Okay, so this means that all of the things that we talked about, the 5-year and 15-year property, which turns out to being, sometimes 20 or 30% of your property value, or mobile home parks, 50 to 80% of the property's purchase price, you could take as a one-time deduction all up front in the first year. So again, this is what bonus depreciation means: is 100% of those accelerated depreciation deductions you can take upfront in the first year of ownership. And this is the last year actually to do 100%, because in 2033, it's going to start phasing out down to 80% and then 20% each year until it's gone, unless the law changes in the interim, which I haven't heard of yet, but it might, who knows. So this actually was a huge game changer for a lot of people when it comes to real estate investing, because again, you can get these huge paper losses, these huge deductions, and essentially pay little tax or no tax whatsoever. And again, those losses are just going to carry forward. So if you don't use them this year, you can use them next year or in the future. So when is the best time to actually get this done? Most people get it done in the first year, and because you want to set it up right. And again, especially with the bonus depreciation, you want to get those huge tax deductions up front. So right after the property is acquired, that's probably the best time to get it done. Although we have many people reaching out to us to get an analysis or at least get an estimate. And we do this even if you have something under contract and you're looking to see, well, I'm looking to buy this property. How much are the tax benefits going to be? We can run the numbers. It takes a couple of days for us. It's a free estimate we do. And but once you do buy the property, you can get this done right away, and it doesn't really cost that much either. Surprisingly, some people think this costs only for huge commercial properties, costs like tens of thousands of dollars to get it done. It's really not. Usually our fees are somewhere in the range of $4,000 to $6,000, and that's pretty reasonable when we're talking about millions of dollars of potential tax savings for larger properties. So you can do it also on a renovation. Remember when I said at the beginning that your depreciation is totally dependent on you as the owner based on your purchase price. And it doesn't change if you get an appraisal. So if it appraises higher, it's like, well, now it's worth twice as much. It doesn't matter. It doesn't change your depreciation amount. Only thing that changes that is if you actually add more money back into the property with capital improvements, with renovations, you can do a follow-up cost seg study on the renovations. And so that's what people will do. At a certain time in the year of the purchase, you do a cost seg on the purchase, and then next year, let's say you do renovations, you can do a follow-up study to capture all the benefits from the money spent on the renovations. And then we have a look-back study, which is something that people don't really know you can do. If you never had a cost seg done and you've owned a property for a year or 2 or 5 or 10, you can actually go back and catch up whatever depreciation you missed. You don't have to do it in the first year. You can actually catch up whatever depreciation you missed in previous years and take that benefit this year.
We have a question in the chat.
Yes.
Chris is asking, so the 100% bonus depreciation only impacts the components on the 5 or 15-year schedule, and it does not impact the 27.5-year components, such as the structure. Is that correct?
That is exactly correct. Yes. The structure is always still going to be depreciating over that 27.5-year schedule. So you'll get, maybe 20, 30% upfront in the first year, and then the remaining, 70, 80% of the depreciation is still going to be taken, on that 27.5-year schedule each year thereafter. So some people think, well, if I take all the depreciation up front, I'm not going to have any deductions later on. And that's not true, obviously, because you're just taking those accelerated deductions, and then you'll still have the remaining, 70, 80% of deductions each year equally over the rest of the year length of ownership.
Thank you.
Yeah, so let's just do a quick multifamily cost segregation case study. So this guy bought a multifamily property. It was a pretty good deal. This was a couple of years ago because prices have gone up since then. So I don't know if you're going to find a 32 unit for 1.75 million anywhere. But this person did it, and it was a great acquisition. Again, this is his first after many single families. And the reason I mentioned this here is similar to what we just talked about the failed 1031 exchange. That's exactly what this person went through. Is they didn't do a 1031 exchange, had a huge capital gain tax bill. And we'll see in a second how that affected them. So again, bought this property, 1.75 million, without cost segregation. the annual depreciation would be about $54,000 because we're taking the purchase price, taking off something for land, and then dividing it out by 27.5, simple deduction. Well, the actual net operating income from this property was about $120,000. So that $54,000 was great, but you're still going to pay taxes on the remaining $70,000, $75,000, right? So what are we going to do? You're going to pay taxes on that or get a cost segregation study done and not pay taxes on that? That's exactly what the person did. So let's see the numbers, how it broke down. We took the purchase price, allocated for land 15%. And again, this 15% is kind of an average that we use. But in his case, this was actually the deduction. But in certain areas in the country, it's less. Certain areas it's higher. It really does depend specifically to property. It's not just like a standard 15%. I just want to put that in there. It does depend from property to property, but this is the national average. That's why I kind of use it for illustration purposes as well. And so we allocated after the whole thing was said and done. And again, a full detailed engineering study of the property. And then the results come in that about 27.5 property, that was about 72% of the total value was going to that. So a little over $1 million. But of the 15-year property, the land improvements, landscaping, pavement, et cetera, all that was about 8% of the total. So 122,000, 5-year property, all of that personal property, again, appliances, furniture, fixtures, flooring, cabinets, countertops, all that stuff, about close to $300,000. So the total amount of bonus depreciation here was over $420,000. What did that do for his income? Again, $120,000 wiped it out completely. And then an extra $300,000 of losses. Well, if you're a real estate professional, you can use that against your active income, that extra $300,000. Or in this person's scenario, he had a big capital gain tax bill from the sale of those single families and actually was able to wipe out the capital gain tax bill entirely from the sale through the bonus depreciation. So this is a good story all in all. And it really kind of illustrates the power of cost segregation to completely wipe out your income tax liability. But it's not all roses. A lot of people like to ask about, well, what happens when you sell a property, or are there any downsides to this? And I would say absolutely. There are certain downsides. This is not necessarily for everyone. This is always why we run a free analysis up front and always have a conversation to make sure that this is going to be, most beneficial to you as an individual. Because this isn't necessarily, if you have a short hold period, or, like I said, if you have investors from 401ks or things like that, you're not going to benefit as much from another person. And the other scenario is when you sell a property, there is going to be a capital gain. And there's also going to be what's called recapture tax, which means any amount of depreciation taken is going to be taxed on on a rate that is sometimes similar to income tax rates, sometimes similar to capital gain rates. There's a few different calculations there. But again, that won't necessarily impact you the same way it would had you not done the cost segregation study. So it's really important to know. People think, well, if I'm doing costing and taking all this depreciation up front, I'm just going to be hit harder on the sale with that recapture tax. And the truth is, there's many myths out there to that. But one important thing to note is you'll have all these losses and maybe offset the gain from the sale because of that. The second thing is something called, I want to get into deep into the details here, but something called partial asset disposition. We're able to actually reduce all the things that you accelerated depreciation on. After a few years, you can literally wipe that out. So you're not even going to be recapture tax on that amount. So that can only be done once you've done the cost segregation study. So again, there are ways to mitigate this. But again, it's not necessarily for everyone. So what should you be looking for when we're talking about cost segregation study? This isn't taken directly from the cost segregation audit techniques guide from the IRS. Again, they made all the rules, they enforce all the rules. And so this is not something you can do on your own. It does require, an engineering, construction experience. There's a whole methodology, a numbering system, a whole nomenclature that has to be used in the reports themselves to be audit proof. You want to make sure it's all listed. You have to source every type of property, like the carpeting or the furniture, all that has to have like a source code to the IRS showing it that that's the lifespan. So it's a very detailed report. It's not just something you can kind of throw a dart at the wall and be like, well, Yonah said 28% of our property, so we're just going to take 28% down and not do the costing study itself. No, you actually have to show your work and get it done to make sure, God forbid, if you're ever audited, you want to be able to pass the test there. So that's pretty much it. I don't really have much more. We're the biggest national company that does this. As Misi said, a lot of people use us, but, happy to take any questions or if anyone has any comments on that.
I'll start with one. I once spoke to a CPA on the real estate space, and he suggested that we could also do cost segregation on single family homes, and that can also be beneficial. In your experience, is that beneficial? If so, how much does it cost typically?
Yeah, it certainly can be beneficial. There's probably a price point where it's going to make more sense. For us, we charge about $3,000. That's kind of our starting point for any type of cost seg study. So that's going to be on the low end, what it's going to cost to get it done, a full cost seg study on even a single family. And any property basically over $200,000-$300,000 purchase price, the returns or the benefit is going to be 10x beyond what you're spending. So it's certainly going to make sense there. I would say if you're talking about smaller single families, probably doesn't make sense.
Got it. Yeah, perhaps there are some other vendors who specialize in smaller ones, because you guys seem to be focused on the commercial real estate a lot more.
We do. I would say you're absolutely right. Our bread and butter is really in the commercial and multifamily space. We do about 5,000 of these a year. So we definitely cover all types of asset classes and do plenty of single families as well. But obviously, it's going to make more sense the bigger the property.
Makes sense. Any questions from anyone?
Hey, Yonah. Yeah, this is Chris here. Thanks for doing this. Really appreciate the time. My question regarding this is, I guess for cost segregation, does doing this kind of study increase your risk of a tax audit in any sort of way compared to choosing not to do it?
Yeah, sure. So that's an excellent question. The answer is no. This does not increase your risk of an audit whatsoever. In fact, I was going to do a post about that today on LinkedIn. If you guys don't follow me on LinkedIn, I highly recommend you do. Check me out. I'm extremely active there, posting multiple times a day. Great relevant content. Not a lot about cost seg, but today I was like, hey, I got to post about cost segregation. And I was going to post this exact point, Chris, that cost segregation does not increase your risk of an audit. I was going to write that in the light of the fact that the IRS just announced, another 87,000 agents to enforce audits. And then I'm like, you know what, let's just focus on the fact that they're increasing, $80 billion. So I just posted about that and didn't mention anything about the cost aspect of it. But yeah, no, it does not. All the rules are completely from the IRS. So I would say the only way that you would be putting yourself at more risk is, if you were ever to be audited and not had a proper cost segregation study done.
Got it. And a second quick follow-up question to that was, I think I just heard from you that, do you have a suggested sort of dollar value, at which or above it's worth it to do? I think I heard a number, 200,000, 300,000. What's your opinion on that?
Yeah, pretty much about 300,000 is like a starting point, I would say. Like anything below that probably doesn't make too much sense. The higher you get, the more benefit there's going to be.
Got it. Great. Thank you.
Yeah, no problem.
Any other questions?
Yeah, I have a question.
Sure.
So you said even if you do this accelerated cost segregation, you said you can only do that on a certain percentage, so that even in the remaining years, you still have some tax deductible amount left. Is that correct? You're on mute.
I muted myself there for a second. Absolutely right. Yeah, you still have. With the cost segregation, we're going to pull from the pool of potential deductions maybe 20 to 30% in the earlier years, but you still have the remaining structural depreciation that you're going to take each year. So just in that illustration, let's say your $1 million property, without cost seg, you would have taken about $30,000 a year. Okay, but you do a cost seg and instead you take about $200,000 in the first year, bonus depreciation. Well, then you're still left with the 80% of remaining depreciation. So instead of $30,000, your deduction is going to go down to about $26,000 of deduction each year.
Yeah, and And I want to add that a lot of times, a lot of the real estate syndications, their hold period is usually 5 to 7 years. So you won't get to like the later part of like year 10 a lot of times. I mean, every opportunity varies, but a lot of times the hold period is so short that you can take advantage of the accelerated way more than the later parts.
Thank you. And one comment I'd like to make is the one thing I learned today that's I think is huge is doing 1031 versus this cost segregation. I didn't even realize that's another option to save on paying taxes when you sell a property, for example, right?
Yeah, absolutely.
So thanks for that.
I need to tag you on a post on that, Yonah.
Yeah, absolutely. Some people like to call it the lazy 1031 exchange.
I like that.
Yeah, it's good. Cool. Any other questions before we close? Cool. Awesome. Well, thank you all so much for joining. I'll upload the recording and share. So appreciate you joining. Yonah has shared his contact in the last slide. He's also very active on LinkedIn, like he says. So if you want to reach out to him, let him know.
Yeah, please do.
Yeah, if you have any questions to me, feel free to message me as well. Thank you all so much. I'm gonna stop the recording here, and Yonah, if you can stay on for a second, that'd be great.